Thank you very much. Great. So now I will go into the substance of the presentation. My apologies for the confusion. The topic is an interesting one, pardon me, mainly because most people are not even aware of the possibility of a fixed income investment or fixed income like investment in the crypto space. Obviously, ICOs have gotten a lot of recent attention, initially because people are making millions of dollars from them, and then because the regulators are making them give millions, or are making them give millions of dollars back. And before that, with way back with things like Bitcoin and how people were investing in Bitcoin or BTC and doing quite well with it, and then some other early pre-label ICO cryptocurrencies came out. And so there's been a lot of hype, a lot of buzz, a lot of rumors, a lot of attention paid to the sector. And I have to say that for a sector that's worth now less than $200 billion, it really has gotten an outsized amount of attention. And part of that is just because when somebody else is making a lot of money, everyone wants to pay attention to it. And part of it is because of the potential here, which is absolutely enormous. That's not the focus of today's call, so I'm not going to go down that particular road. But it really, not so much cryptocurrencies themselves, but the blockchain and the tokenization of real assets, which I think are going to be bigger than the tokens that we're really going to focus on today. Those two trends are going to have a massive influence on much of the world as we know it. Now, what we're going to focus on specifically is a different way of making money in the crypto space. As I describe it to investors that come to me and ask questions about the crypto space, is how can you play in the crypto sandbox without experiencing this insane volatility, right? BTC, as an example, it's a reasonable representative of the space, was at less than $1,000 in April of last year. It hit $20,000 just around Christmas last year, so up 20x. And today it's struggling to stay above $6,000, so down 70, up 200 or 2,000% and down 70%. Which actually still makes it a pretty good investment, right? It's up 600% in the last, call it 18 months, which by any stretch of the imagination is a fabulous investment. Some of the other cryptocurrencies in the space have fallen a lot more than BTC itself. Again, a subject for a different conversation in terms of correlation within the crypto space and BTC dominance, that is how much of the entire market cap Bitcoin represents. But there is a way to play in this horribly volatile space that's much less risky, much simpler in some ways, more complicated than others, depending on which road you go down, and in a way that, in the case of several of these, there has been no downside, no defaults, no drawdowns. So we're going to focus on just really three categories of fixed income investments and a couple subpoints under a couple of the categories. The three categories are lending, so lending both US dollars or fiat and cryptocurrencies. And the second category is masternodes. And the third category is mining, and there are a couple of different subsets under that. So let's briefly talk about the first, which is lending. There are two major ways to lend in the crypto space, and keep in mind this is evolving very quickly. One of the reasons the crypto space evolves so quickly, by the way, is because it's already got a roadmap for evolution, and that is it looks at what happens in the fiat, what happened in the fiat space. So in the regular classical financial space, which we call fiat if you're in the crypto industry, and that is, you look at things that, like, you have straight up equities, then you have, or commodities actually is probably a better example, then you have futures, right? Farmers who want to buy their seed with money from the harvest in September in the northern hemisphere. And so you have futures come up, then you have indices that come up, then you have options that come up. All of that evolution, which took place over, well, call it the last 70, 80 years. If you're talking about commodities futures, it's more than it's hundreds of years. But the that evolution is very clear. It's happening very quickly in the crypto space because we know it's coming. So what we have here in the crypto space is the early way of, slightly modernized, an early way of lending money, or of lending and generating a return. The easiest way is on several exchanges is simply peer-to-peer lending, which is a modernized version, really, if you will, of lending on margin. What that means is if I've got fiat, or let's use US dollars because that's where the call is based. If I've got US dollars and somebody else thinks, let's use Bitcoin as the obvious example, is going to go up, they're going to borrow dollars from me and buy more Bitcoin. And hopefully the return I get on, if I'm the buyer, if I'm the borrower, the return I get from the increase in the Bitcoin and the price of Bitcoin exceeds the interest rate I'm going to have to pay. Now that sounds pretty mundane, and we do that now at anywhere from 1 to 4 basis points a day. And so we're looking at somewhere in the neighborhood of 8 to 15% a year. That interest rate has been as high as 500 basis points. And I'm not talking about 500 basis points a year. I'm talking about 500 basis points a day. That was the case last August. Now, obviously, that's not sustainable by anyone, and it was for about a 3-week period. But we'll often be able to lend out money at 10 or 12 bips a day. If memory serves, 18.2 is 100 a day is 100% annual return. So we've got in my fund, which I don't want to focus on at all, we've got a share class that only does this and has never had a down month. So the idea is that you can lend out fiat. Right now, interest rates are very low because if you know anything about the crypto markets, if you monitor it, prices are very low. There are very few people that are going long in the crypto space, much less leverage long. So interest rates are low. The other kind of peer-to-peer lending is peer-to-peer lending in crypto. So if you think Bitcoin is going to go down, for instance, you will borrow Bitcoin at a certain price, with a certain transaction cost. The price goes down, and you borrow the Bitcoin, you immediately sell it. The price goes down, you buy it back, you keep the dollar delta less the transaction cost you paid for having borrowed the BTC in the first place. Those interest rates are higher right now, and they've been trending higher over the last several weeks because many more people want to short than wanted to in the past. The issue there, of course, is that you have currency risk. If you're measuring your returns in dollars and you bought a bunch of Bitcoin, of BTC, and then you lend it out to someone, you will make right now it's about 1 basis point a day in BTC. It's about 2.5 or 3 in ETH, in Ethereum, which is the second largest cryptocurrency. If you do that, you will make your interest, right? That's secured. It's not guaranteed in peer-to-peer lending, it's secured. And to our knowledge, there's never been a default, but I can't speak 100% to that because there's not a central reporting agency, but had there been a significant default, there would have been obviously a lot of news about it, and we know of none such. But the problem is, if in the meantime, the guys who are shorting Ethereum, who are borrowing ETH from you or BTC from you to short it are right, the value in US dollars of what you own is what you bought, which is the BTC or ETH, is going to drop more than the money you get from lending. So there's an additional risk if you're measuring returns in USD or in fiat and you lend out to shorts in crypto. So, but it's a fixed income, and if you're measuring results in USD and you only lend out in USD, you don't have the currency risk. And like I say, it's possible without exception to simply make a little bit of money on an annual basis. When we do that sort of thing, we look at the U.S. high yield rate and the lending rates that it's possible to get with a reasonable amount of following the market. The crypto market exceed that of the U.S. high yield rate. The second way of lending is lending to other counterparties. So there are organizations springing up now out there in the crypto world that are targeted at what is sort of tongue-in-cheek or half tongue-in-cheek called HODL investors, H-O-D-L, which is a misspelling of the word hold, and the gentleman who coined that, or some people who came afterwards, said, what does that stand for, this HODL? So it now stands for hold on for dear life. And these are investors that bought BTC or mined BTC years ago when it was very, very inexpensive, and they're just sitting on it. They're holding it. They don't want to give it up under any circumstances because they're convinced that the markets are continue to rise, particularly the BTC market. And these organizations spring up, and what they're offering is, I just saw one this morning, it was a 6.75% annual interest rate on your BTC. And that may or may not be a good deal. I don't want to judge that. But if you're on this call and you're sitting on crypto, you can lend it out yourself. You can invest in, there are a couple of fixed income vehicles, there are very few, or you can lend it to these third parties. The problem is you have two levels of counterparty risk at that point in time. So there's some potential disadvantages there, but most importantly, you already have to have the crypto, because if you want to generate USD returns, buying BTC or ETH to either do peer-to-peer lending or to lend to third parties is probably not worth the risk exposure unless you think the market is about to turn around. And paradoxically, in a rising market, you're much better off anyway in fiat, because people are going to want to borrow fiat to buy additional crypto to take leverage long positions. So there's an interesting dynamic there. But most importantly, if you're not an experienced crypto investor and want to diversify your portfolio into the crypto space, and want fixed income or fixed returns or semi-fixed returns, because the terms on these, I neglected to mention, the terms on peer-to-peer lending are from 1 to 30 days. So it's something that you have to quite actively manage. But nevertheless, the interest rates, unlike the fiat world in some places, are never negative. So you're always gaining something, and it's more than 100% secured. So it's an interesting arrow in one's investment quiver, particularly in the crypto space. The second area is masternodes. Masternodes are the guts behind the blockchain that make the blockchain work, and obviously a very non-technical definition. But if you read about the blockchain, you understand that there are millions of copies of various blockchains, and there's a fee you pay which goes up and down depending on supply and demand, effectively. And the masternodes are the various computer nodes, servers located in various places, which make all that happen. They're related to mining, but you don't actually have to mine to run a masternode. And it's simply providing the hardware backbone to allow a blockchain to work. And there are fees that you earn if you own a masternode. We've actually done some really in-depth analysis, building an entire financial plan with man-months of effort to really populate this well, and did analyses of probably 100 different cryptocurrencies to do a masternode. And what it boils down to under masternodes, it's interesting. It is definitely a fixed income or fixed income-like investment, because you will constantly be charging fees as long as the network is used, and so you have to be careful about which one you pick. The trick, though, is that on masternodes you're actually paid in the crypto. I don't like cryptocurrency, I prefer crypto asset. You're paid in the crypto asset for which you're providing the backbone. And as a result of that, certainly you're paid, and you're paid on a steady basis, and you're paid for every transaction, and that's very good. But because you're paid in that crypto asset, you also have market risk. So you're also subject very much to the cost on an exchange as to how much you're reimbursed if you're measuring that in fiat, and particularly if you're measuring in US dollars. So you have two kinds of risk there. How much is the node used? How much are you earning? How much can you charge, which is generally not something within your control. And then secondly, the market risk. And as we did our analysis, we built the financial plan, then we did a sensitivity analysis. And we discovered that it's about a 60-40 split. 60% of the variability of your income is due to market price, and 40% is due to the various other factors that go into billing, if you will, or how much you charge for the Masternode. So ultimately, we decided, we were thinking about launching a separate share class in this. Ultimately, we decided that no, we've already got the trading infrastructure, so fine, we're not going to do Masternode. Having said that, it was not a super clear-cut decision, and there are a number of companies that are in which you can invest in various ways that run Masternodes. There are three in particular, or you can set up your own. It's actually not complicated to set up your own Masternode. The third and last area we'll talk about for fixed income is mining. Mining is also interesting. You may have heard about mining in various places. It's an interesting term, even applying mining to crypto assets, because ultimately what you're talking about is solving a computer problem, and if you solve it successfully, you're granted a spontaneously generated for you whatever the crypto asset that you're mining. And keep in mind that some of you on the call, I'm sure, are aware of this, but not all crypto assets are mined. They're generated in various ways. Some are just automatically created all at once at the beginning. Some are mined over time. BTC has just over 20 million that will ultimately be mined. Last I checked, I think there are about 17 million that had been already, but the difficulty increases as more and more are found. So the varying dates when the last Bitcoin will be mined, I've seen them as early as 2021. I've seen them as late as 2040. It depends what happens, because the difficulty increases as you get closer to the maximum number. And then the mining will stop, and then Bitcoin, the only way to make Bitcoin from an infrastructure standpoint is to run a Masternode, which we've already talked about. But currently, though, this mining, or the solving complex computer problems to generate certain crypto assets, those that are generated in this fashion, there are several ways, three major ways of investing in them. And why are these all fixed income? Or why am I talking about fixed income or fixed income-like? And that is because just statistically, if you put X number of hash power or X number of computer power into trying to solve this problem, you will eventually be right. Now that means that if you have one computer and it's hacking away at the problem, maybe once a year, depending on how powerful that computer is, you will get one Bitcoin. But what people do is they have many computers, and then they join those many computers into pools, into mining pools. So somewhere in that mining pool, and some of these mining pools can control a significant percentage of the hash power, which is a computer term for computing power, essentially, hash power that is required to, or that is used or dedicated toward BTC mining, BTC in particular. And so on a statistical basis, you're going to have pretty much a steady trickle of a portion of a Bitcoin, which fortunately can be fractionated to 8 decimal points. So if you've got 100 computers in your pool and you combine with a whole bunch of other pools and you've got 10,000 computers, every couple of days or every couple of hours, you're going to get a Bitcoin, and because you're going to solve this problem before anybody else does, and everyone on that network will get, in this case, 1/10,000th of a Bitcoin. And over time that adds up, and it generally can be quite profitable depending on what the Bitcoin is worth at any given time. You can do that. It is possible for someone to buy a mining rig. They're relatively easy to purchase. When prices are down, they're much easier to purchase than when prices are up. So right now you can actually get good deals on mining rigs. The biggest variable cost to a mining operation, by the way, is electricity, because what you're really doing is turning electricity into a crypto asset or electricity into BTC. So if you're paying more than, say, 4 cents a kilowatt hour, you're probably not going to be price competitive. But you can do all of this. It's a bit more complex. It takes nowadays it takes quite an installation and some real efficiencies. So there are a lot of mining operations that are starting from scratch now. But there are a lot of people that just have a rig or two set someplace where they don't pay for electricity, or it's included in their costs, and they mine away, and every once in a while they get a pleasant surprise. That is possible. Not very efficient, and certainly not for large-scale investors unless you really want to go large-scale, because right now it's millions of dollars to set up an operation that will have a high likelihood of being successful and have a decent ROI. The second major way, is hash contracts. there are other companies, a number of them, that have set up operations where you can buy a percentage of the upside. So more technically, you buy a percentage of the computer power, and say you buy 5% of the computer power, then you're going to get 5% of the BTC that are mined, less a certain margin. We've looked at these companies, and generally the terms they offer are not particularly attractive. And that's starting to change now because of pricing pressure. But it's something that it's not a bad investment, but if you're in the crypto space, it's probably a better one. If you're not in the crypto space, it's actually quite a good way to get into it because, again, it's quasi-fixed income. There's a variability portion in terms of what is the BTC worth, but you put in a single amount, and thereafter you'll get a steady trickle of BTC. By the way, as the more and more BTC are mined, the difficulty increases, and the hash power required to generate, or the computer power required to generate a single Bitcoin increases. That means that the hardware that one buys eventually becomes outdated because the electricity it consumes to generate a BTC will be more expensive than the BTC. And so the half-life is probably about 8 months. Or maybe, the half-life actually is probably about 6 months. So you're going to get half the results after 6 months, and half again, and half again. And at some point in time, the electricity results increase or exceed what you're getting. As a general rule, you can use a rig for 12 to 18 months, and then you're and then you're going to have to replace it. The last is private equity investment, and there are a number of companies, and they spring up periodically. As I mentioned, it takes single or double-digit millions to achieve a decent ROI in this. And so I just got a note that's saying the sound is not coming through. Could someone just please confirm that the sound is coming through for the 6 minutes we have left? I see some comments here, and just want to confirm that. Okay. Don't hear any confirmation. Don't see any confirmation. All right. I'm going to continue as if the sound is working. My apologies if there are any issues with the sound. So last one is private equity investments. And this is standard, very standard PE. There's a project, there's investment, there's a business plan, pre-post money evaluation, or valuation rather. The very, very standard private equity project. If you're looking at these, there are some things that I would strongly recommend you pay attention to. One is, as I mentioned, cost of electricity. The single most important variable, other than price of whatever you're mining, and we'll use BTC as an example, is electricity costs. 4 cents per kilowatt hour seems to be the turning point. Some people claim in places like Eastern Washington or China or Iceland to push the price down to 2 cents per kilowatt hour or even less. And at that point in time, you're probably making very good money. But so you need to look at that in any sort of private equity investment to make sure that there's some longevity behind the arrangement with the electricity provider. There's a fascinating project that's being built in Canada right now. I should say I'm not sure it's actually started being, the construction has started, but they've raised most of the money they need to do this project, and that is to put up their own, they've raised money to put up their own hydroelectric electricity generator. So it's all going to be completely self-contained. They generate electricity there. The mining rigs, well, I guess not completely self-contained, the mining rigs will have to purchase, and then they will mine BTC until probably much longer than most people could use those same rigs, because the cost has been sunk, and their fixed costs will, as a result, be lower. Obviously, they've got to amortize that investment, so it's not free by any chance, by any stretch of the imagination, but it's an interesting approach to this. Some people have tried a solar approach as well, but I haven't seen any really successful projects that work on solar. I understand there are a couple in the Middle East, in the GCC, that are starting now. That may be something that works. I don't know, but really look at the price of electricity, and then also look at how long the hardware is being used, because it is not usable for a very long period of time. And the last thing you should look at is who's deciding what to mine when, because with sometimes different kinds of hardware is required for different kinds of mining. I don't want to go into that now, but most hardware you can use for several types of mining, and then you have or mining of several types of crypto assets. Then you have the question, okay, which one should we mine now? What percentage of our machines should we allocate to mining one crypto asset versus another crypto asset? Now, we've gone 27 minutes here, and so if anyone has any questions, I'm happy to address them in the last couple minutes or so. But that is really, those are the mechanisms. The easiest mechanism is peer-to-peer lending, and that you don't have to get your hands dirty with hardware and stuff. But there are a lot of different ways to invest in fixed income or fixed income-like investments in the crypto space. These don't grab the headlines. They're not all that interesting compared to 10x or something in an ICO, which could just as easily go to 0.1x. But it's an interesting category. I constantly recommend that people diversify both between crypto and fiat and within the crypto space. So this is a good aspect, a good type of investment to have in your crypto portfolio. So any questions, please? Okay, well thank you for your attention. I see quite a few people have actually signed up for this now that once we got started. I appreciate your attention and hope that you learned something from this. If you have any further questions, feel free to contact me. My email address is tim.enneking, ENNEKING, at crypto-asset-management.com. Thank you very much. Bye-bye.